Well, good morning, everyone. It's Friday. Happy Friday to everyone. It's November 8th. The market's going to open in about an hour and 12 minutes or so. Got a lot to talk about this week. It's a good time to begin reflecting on earnings. Why? Well, we've had a little bit over, I believe, 403 or 400 S&P members released. That's about 80% now. So, where do we stand? Let's talk about the numbers, the good and the bad. And 400 out of 500, that gives us a good amount, a good number. It's enough to give us a good picture. If you hear a sound in the background, like a little, that's a cat. I have a white little Persian cat that keeps wanting to go back and forth, back and forth. He's a kitten, so he's really cute. If he comes around here, I'll grab him. Actually, let me grab him for you really quick. Okay. All right. So now that we're back, I had to show you the cat, right? You wanted to see the cat, right? He's a miniature Persian cat, and he has beautiful blue-green eyes. It's breathtaking. I've never been a cat person, but recently I've changed. So back to the S&P 500. 400 out of 500 members have reported already, and let me give you the expectations. 73% out of the 400 out of 500 beat earnings per share estimates. So that's really good. 58% beat revenue. Not great, but not bad. But here's the thing you need to understand. These are earnings per share estimates that are based on expectations. So the expectations were beat in terms of revenue and earnings per share. Expectations. Now let's look at the actual numbers, okay? They're not as great. The actual numbers are, we're down actually 1.7% from a year ago. We're not up. Companies are down. The PE ratio of the S&P 500 right now is lower. I think it went from 19 to about 18. Don't quote me on that, but it's lower because companies are earning less money, but 4% higher revenue. So we're not really seeing a major slowdown. I mean, 1.7%, 4% better revenue, but we're not seeing these numbers that you're seeing in the expectations. So while 73% beat expectations or 58% beat revenue expectations, those are expectations based on everything the analysts know about China and so forth. But if you look at the actual numbers, they look okay. They don't look great, but they don't look bad in light of what's going on with China. Now, let me move on. Today, we only have one major stock reporting, and that's Duke Energy. And then next week, we're going to finish up the remainder. Actually, over the next 2 weeks, we're going to finish up the remainder, and that'll be retail. Retail is really important because it gives the market a chance to really make a move before New Year's and into New Year's. That New Year's rally you see, it typically happens when the GDP and the retail is really good. Retail accounts for 2/3, I believe, of the economy. So it's really important to see what the retail sector has in store for us. Retail store for us. Okay, so now let's talk about China. It's really interesting. Anytime we get this promising news on China and U.S. trade war, we see the market rally for a few days, and then the exuberance, and then the exuberance just fizzles out. The excitement fizzles out, and I'm seeing that right now. I'm already seeing talk about possible breakdown in communications, possible fact that China wants U.S. to take action before going into phase one. There are so many roadblocks, and I believe what you're seeing in the news is a deep, deep oversimplification of the issues. So, in my opinion, over the next few days, the market is going to reflect fundamentally that there really isn't much progress, and the market will reflect that by coming right back to the 50-day line. And I've been saying this over the last few days, but I really believe we're close to that. Also, let's check the put to call ratio real quick. This is the put to call ratio. And right now we're back to being deeply overbought. Yesterday, the put to call ratio went as low as 59. And when you see the put to call ratio below 75, it can't sustain itself. It's too much accumulation, too much buying pressure. Similarly, when you see too much selling pressure, the put activity gets really high to the 135, 140, it pops back like a rubber band. You see, when it's near the median, the average, it's not really out of character, out of line. But when that rubber band snaps back a specific amount over a short period of time, it can't sustain itself that much. And that's why I'm expecting this market to begin cooling off. There's actually a practical reason for it. So earnings are better, not because they're really better. They're actually, they're down 1.7% from a year ago. So we're not seeing really a lot of growth. And here's another thing. I just remembered this. If we do make progress with China, if we do, and I don't think we will right now, what do you think the Fed's going to do? They're going to start saying, you guys don't need lower rates anymore. And they've lowered rates 3 times already this year. We're done for the year. But the point is, they may start moving into the other direction. And the bond market, if you look at the bond market, even though the Fed said they're going to lower rates, let me show you something a little cleaner. We've been doing too much analysis on this asset, as you could see. We're moving right here. Notice the Fed lowered rates. What happened to bonds? They went lower. Remember, interest rates and bonds are inverse to each other. So typically when you see Fed saying we're going to lower rates, you see a skyrocket. Bonds, that's what happened here. Didn't happen last time. Now, I do believe bonds are going to rally because I believe stocks are going to start coming down right here. Let me show you. To the 50-day line. And whenever stocks come down to the 50-day line or lower, you will see a rally in bonds, and I think that's coming. So don't expect too much more upside before seeing a pullback, and then we'll have another leg up if things with China are better. But also keep in mind, the better things get with China, the worse or the slower, or the Fed may not even slow down how quickly they lower rates. They may start raising rates. So again, remember that it's not really a great silver lining here. And the market will adjust. So again, I'm not seeing a major downturn, but I am seeing a cautiousness over the very, very short term. And again, if you look at the small caps, got to follow the small caps. We haven't really broken above the channel high. If you look over, say, 9 months, we never took out the channel. So we never made new highs on the small caps. We made new highs over a year ago. Yeah. So we've been in a channel, and this channel still did not reach its top, and it's deeply overbought, and it's coming down. So the market needs to, when the Russell comes down right here, which should be in a few weeks, comes down right here in price to the 144, that's a good time to begin accumulating. When the S&P 500, the SPY comes down right here to this moving average right here, or even to this line right here, that'll be a good time to begin accumulating aggressively. Till then, be cautious. Lower your exposure. Start thinking about assets that are not correlated to the stock market, like bonds, gold, GLD, just for a little bit, just till we are back on track. All right, folks, you have a wonderful weekend. Don't get into any trouble. Stay out of trouble. I'm excited. I'm going to see the Sting concert tonight with my wife. I'm taking her to the Sting. Actually, she got tickets. My birthday was last week. She got tickets for my birthday. It was a surprise. I'm going to see Sting. Really excited. If you guys are getting something out of it, please, please, please give me feedback. Give me comments. Talk to you guys soon. Have a great weekend. Bye.